Hello class, and welcome to the video lecture for recording transactions for dividends, treasury stock, and retained earnings. The last learning unit is about the statement of retained earnings and appropriations of retained earnings. Appropriated retained earnings is a portion of retained earnings that the corporation is saving for something in particular, and it's not available to distribute as dividends. It's simply a different ledger account. For example, if a company wanted to save $20,000 of its retained earnings for an expansion, it would debit retained earnings to reduce it and credit a new general ledger account, calling it retained earnings appropriated for expansion. The statement of retained earnings is one of the financial statements of a corporation in addition to the balance sheet and income statement. It's similar to the statement of owner's equity for sole proprietorship. It reports the changes in retained earnings. Retained earnings can change, either increasing or decreasing, due to net income or net loss, dividends being declared, or prior period adjustments. A prior period adjustment is the correction of a mistake made in a previous year. The correction is done by updating the beginning balance of retained earnings, since net income or net loss from the previous year has already been closed out to retained earnings. These kinds of corrections are only made if the error is considered material. Material means it makes a difference to the financial statements and the users of the financial statements. Let's look at an example. 8 months after the closing of its books, Ralston Company discovered that depreciation was understated by $12,000, which meant that in the previous period, depreciation expense was understated by $12,000 and net income was overstated by $12,000. If net income was overstated, retained earnings was also overstated, because net income is closed to retained earnings. To correct this error, we reduce retained earnings with a debit of $12,000 and a credit to accumulated depreciation of $12,000. This entry updates retained earnings and accumulated depreciation to what they should be. The correction is listed on the statement of retained earnings as a deduction to the beginning balance of retained earnings. So that wraps up Chapter 19 and accounting for stock transactions. Next week we'll be looking at bonds, another way for corporations to acquire capital.